Welcome class. We're going to be getting into corporations, partnerships, limited liability companies, limited liability partnerships this week. In addition, there's another chapter, but for right now, I'm going to cover C2. And then in separate videos, I'm going to cover C3. So let's get started here. So chapter 2, corporate formations and capital structure. The way that I'm going to do these videos is I'm going to kind of go through the corporate formations because they're fairly straightforward, and I think you guys have some experience with it. And then we get into section 351 exchanges. That I'm going to spend a bit more time on because it's going to be new to you, and there's some critical thinking involved. Whereas this is a little more straightforward. So anyways, let's get to it. Learning objectives. Discuss the tax advantages and disadvantages of alternative business forms. Apply the check-the-box regulations to partnerships, corporations, and trusts. Recognize the legal requirements and tax considerations related to forming a corporation. Discuss the requirements for deferring gain or loss upon incorporation. Explain the tax implications of alternative capital structures. Determine the tax consequences of worthless stock or debt obligations. Identify tax planning opportunities in corporate formations, and finally, comply with procedural rules for corporate formations. So here are organizational forms. So you can be a sole proprietorship, which is a Schedule C. We covered that. You could be a partnership, that's 1065. That's two people going into business together and not incorporating. You've got corporations that could either be single or multi-membered. You've got LLCs, limited liability companies, not really a tax entity type. It's more of a legal entity type, but it's here. And then we've got limited liability partnerships. So advantages of sole proprietorships, Schedule Cs, we've kind of covered some of this. You're not subject to a second layer of tax, meaning there's no double taxation that occurs on C corporations where they distribute dividends. Can withdraw cash without dividend treatment. Lowest individual marginal rates are less than the corporate rates. Right now, the corporate tax rate is 21%. There's discussion from Trump about reducing that to 15%, which I'll get into a little bit later here. But business loans can offset owners' other non-passive income, business loss. You probably would have seen that on, I think it was the Chamber's tax return. Whoever had the band that lost some money, that gets factored into your other income that you're Schedule C. Qualified business income deduction, commonly referred to as QDI, allows exclusion from tax of 20% of net profits, meaning if I have $100 in net income, I get a $20 deduction. So my taxable income would be $80. No separate corporate tax return or payroll. You're looking at quarterly payroll tax returns, 941s, state returns. There's less admin work involved with it. Disadvantages of sole proprietorships. Profits are currently taxed even if not withdrawn, so that $100 that we have, even if you don't withdraw that, you're paying taxes on it. Certain fringe benefits may be taxable to owner, must use calendar year tax year. Because it's a disregarded entity, meaning that it gets reported on the taxpayer's tax return. They would have the same year as the taxpayer, and taxpayers use calendar year end 12/31. So would disregarded. Highest individual marginal rates are greater than the corporate rates. So the highest marginal rate is 37%. That's greater than the 21% corporate rates, possibly being reduced to 15%. All profits subject to self-employment tax. That's a big one. Again, I think I've given this example before, but if we have 100,000 net income from a disregarded entity, multiply that by 92.35, that by, so 14,130 just in self-employment tax, plus that 100,000 gets added to your ordinary income. So it can be a lot of tax with sole proprietorships. Can't have a second owner and unlimited liability. That's unless you're a limited liability company, but for the purposes of this, we're not an LLC, we're just a Schedule C with no LLC designation. So forming a partnership. So here you've got partner A, they're contributing property. It's got to be equal to the amount of the fair market value of that. It's got to be equal to the amount of cash contributed by partner B. And now we have a partnership, right? It's two people going into business and not incorporating. That's what the check the box regulation for from learning objectives is you have two people going into business together. They're automatically a partnership unless they check the box to be incorporated. And we've got two types of partnerships, general and limited. So general partnerships, general partners have unlimited liabilities for the partnership's debts, and the liability can be greater than the capital invested. They can come after you personally. Limited partnerships are liable only up to the capital invested plus the agreed upon amounts in the partnership agreement. And you got to have at least one general partner, and then you can have a limited partner. But you need at least one general partner. Advantages of partnerships, no entity level taxes. They are a tax reporting entity. They're not a tax paying entity. That income or loss flows through to the partners. So there's no double taxation. A partner's marginal rate may be less than the corporate rate. Again, marginal rates are 0, 10, 12, 22. The 22 would be higher than the corporate tax rate of 21%, but the 0%, 10%, 12% brackets would be less than, obviously. Contributions and distributions are usually non-taxable, assuming it's not in excess of your basis. Pass-through income losses can offset items on partners Form 1040, and you get the QBI deduction for partnerships. Disadvantages, profits currently taxed whether or not withdrawn, similar to sole proprietorships. If your K1 reports you have a recognized gain of 100,000, even if you didn't withdraw it, you're paying taxes on it. You'd increase your basis in the stock of the partnership, but you still recognize that. Partner's marginal rate can be greater than the corporate marginal rate, right? You could have a 31% partner rate and the corporate rate's 21%. No tax-free fringe benefits, since partners are not employees, must generally use calendar year tax year. And if a general partnership or general partner, you have unlimited liability. One thing that they didn't add here, partners, because they're not employees, would still be subject to self-employment tax, similar to a sole proprietorship. Now we're getting into corporations. So you've got shareholders, they make up the corporation. So advantages of the C Corp, different than an S Corp. We'll get to S Corp in a little bit here. Possible lower marginal rates on entity basis. Again, it's 21%. You could have partners that are well into the 37% bracket, or shareholders rather. So the 21%, you'd be recognizing a tax savings. Shareholder employees can have tax-free fringe benefits because they are employees. Corporation must use fiscal year tax year, meaning you can kind of pick and choose. There's got to be a business reason for it, but if you want to recognize your tax year as, tax year ending on 6/30, you can do that. Top corporate marginal rate is 21%, more flexible ownership options. You can have various number of owners, you can have various types of owners, various types of stock. Disadvantages of C corporations, double taxation due to entity level tax. When people talk about double taxation, this is hopefully what they're referring to, because this is really the only entity type that recognizes double taxation. You've got your corporations, let's go back to the 100,000. You automatically pay your 21,000. So we've got taxable income of 79,000. Okay, this is what we have afterwards. If we distribute this out to partners in the form of dividends, or to shareholders in the form of dividends, they would also recognize a gain on the dividends, right? So you pay the 21,000 tax. And then when you distribute out what's left, the 79,000, the shareholders would recognize gain on those dividends at their marginal rates. So that's where the double tax comes from. Shareholder may have taxable dividend upon distribution of property. Kind of covers that, but it's property. It could be assets, it could be cash, it could be whatever. Net operating losses and capital losses stay at the entity level and don't pass through to the shareholder. That's a big reason why a lot of C corporations stay around, is that they still have NOLs to use up. Once they opt to become an S corporation, or even a partnership, let's say, they don't get to keep those NOLs, so they stay with the entity. Cannot take the 20% qualified business income deduction, so QBI is not eligible for C corps, and there's no preferential rate for long-term capital. It's treated as ordinary. Advantages of S corporations. Probably what you see the most right now could change if the marginal tax rate for C corps gets lowered from 21% to 15%. Then you're going to see a lot of people that think that that's a pretty attractive offer, right? 15% is going to be considerably lower than an S corp rate generally. Your marginal rate for an S corp owner could be 37%, whereas with a C corp, if it drops to 15%, that's a 16% difference. That's significant. Anyways, getting back into it, S corps not subject to tax on an entity level. It is a pass-through entity similar to a partnership, so there's no double taxation. Shareholder may have a lower marginal rate than a C corporation. Kind of just covered that. Non-passive losses can offset any income on shareholders Form 1040. Income and deduction items retain the character. QBI deduction allows for exclusion from tax of 20% profits. And option to save self-employment tax dollars via reasonable compensation. So S corps generally not paying the self-employment tax like partnerships do. Disadvantages of S corporations: shareholders taxed on all profits, even if undistributed, similar to sole proprietorships and partnerships. Shareholders' marginal rate could be greater than the C corporation. No non-taxable fringe benefits for shareholder owner. Must generally use calendar year accounting period. I've seen a couple fiscal year S corporations because they were grandfathered in. I think the S corporation designation came around in the 80s and 90s. And if you were around before that and switched and you were using a fiscal year end, you could keep that. A lot of people went to just the calendar year end because it's how people think. It's December 31st. Perfect. That's my year end. Other people like the fiscal year end. Limited number and types of shareholders. So it doesn't get into this, but you can't have more than 100 shareholders. You can't have any alien shareholders. So, we're pretty close to Canada. If you have a shareholder from Canada, you've got to either be a partnership or a C corporation. You're not allowed to be a C corporation. You may have additional compliance requirements versus sole proprietorship, various payroll tax returns you've got to file, and requirement for taking reasonable compensation. The IRS is purposely vague on, what is a reasonable compensation. Generally, you should be the highest paid person at your company if you're the owner. If you only work, and this is what I've kind of seen from the IRS, let's say you make, 20,000 and you only work there 10 hours a week. But you have someone, your CFO is making 100,000, working there 40 hours a week. They're going to multiply this by 4, right? Because you're only working there, what did I say? 25%. Let's say 25% of your time is spent there. So, if I do this, 20,000, you're spending a quarter of your time there. They're saying that your reasonable compensation should be 80,000. If your next highest employee is making more than that, they might take issue with it. But Generally, there's a couple things that go into figuring out what's reasonable. You know, if I am, my net income from my S corp is $1 million and I have a $10,000 salary, they're probably going to take issue with that. You're generally going to look at it as your compensation should be about equal to what your net income should be or will be. But they use reasonable to kind of take the onus off. So you got to use your judgment on it. You know, you can't have 1 million of net income and pay yourself a salary of 10,000. But there's some wiggle room there, you know, maybe $250,000 salary on 1 million of income, they'd be okay with. So there's a lot of gray involved with the reasonable compensation requirement. So advantages and disadvantages of limited liability partnerships and LLCs. Generally, a partnership that is a limited liability partnership, because you saw that general partners have unlimited liability. If you take the LLP designation, and again, that's more of a legal entity kind of type than a tax reporting type. The partnership would still file Form 1065. Everything else is kind of the same from a tax perspective. But you'd be getting the benefit of what the S corp has with the limited liability. So that's the advantage of the LLP. So check the box regulations. This is literally checking a box. That's why they call it that. It's you mark a box on the form and you're now you were a partnership, now you become an S corporation or a C corporation. So it's available to unincorporated businesses, can elect to be treated as a partnership or a corporation. Two or more owners default as partnership unless you check the box to be treated as a corporation. And if one owner default is a disregarded entity, unless you check the box to be treated as a corporation. Okay, now we're going to be getting into section 351, which is going to be its own separate video. So I'm going to stop this here.